Coming up as the RBA prepares to meet next week, we take an in-depth look at the direction of global interest rates. Hi everyone, it is Friday the 3rd of May 2024. The Australian share market rose today, the S&P ASX 200 up 0.6%, 7,629. It follows a busy week in terms of interest rates, with the US Federal Reserve keeping rates on hold, but ahead of the RBA decision next week. For more, I spoke with portfolio manager Nick Schoemaker from Drummond Capital.
Yeah, hi Ricardo. So the market is on track, I think, for its fourth advance in 5 sessions, and that is after global markets had been rattled throughout April because of the prospects of interest rates being higher for longer. We saw a big repricing in bond yields and a sell-off in risky assets. So what's been driving the positive tone is the US Federal Reserve meeting this week, where Fed Chair Powell did strike a dovish tone, and that has started to spark a rally again through the month in risk assets. So investors were very much positioned for a string of hot inflation prints, seeing the Fed potentially be hawkish. So that being ruled out now has been very positive for markets. And also the technology sector, specifically today, is doing very well after Apple announced, I think it was about $167 billion buyback.
I want to go into US interest rates in more detail and add something else to the mix, right? So the OECD overnight warned that interest rates may need to stay higher for longer, but that there is scope for cuts globally this time. Is this what the market is thinking too, especially after the US decision to leave rates, as you mentioned, on hold this week?
Yeah, so if we go back to December last year, the Fed came out with their dovish pivot. That was after we had goods disinflation, and very quickly the market priced in about 7 interest rate cuts for 2024. So ever since the start of the year, Ricardo, you've had both the Fed and the markets continually push back on that very dovish pricing. What you've seen now for the first quarter this year has been 3 consecutive months of core inflation coming out higher than expected, and there's really only one rate cut now priced in. So it does vary by country. It does vary by region. If we look at the US, the futures are implying an 88% chance of a rate cut in November. If we look at that before the Fed's meeting this week, it was 58% on Tuesday. And there's one cut fully priced in before Christmas this year. So to answer your question, market pricing is actually a little bit more dovish post the Fed meeting, because rate hikes were essentially ruled out by Powell. If we look, Ricardo, at Australia, traders are actually still wagering the next move will be up, not down. And in fact, markets are pricing in close to a 50% chance of an increase before year end, which would take the RBA cash rate to 4.6%. And in Europe, just to show you again, there is some slight divergence. It is expected that an interest rate cutting cycle will begin in June this year.
Before we go into more detail about Australia, just on the US decision and the statement, was there any interesting changes in there?
Well, it was interesting, Ricardo, just on a whole host of fronts, because the market, as I said, through April had started to reprice out interest rate cuts. So there was an expectation that Fed Chair Powell would be quite hawkish and perhaps have a hawkish pivot. What we saw from the meeting is that Fed Chair Powell didn't come out hawkish at all. While he did prepare his marks to acknowledge that inflation has been too high, he did really essentially dismiss many of the concerns around accelerating inflation. So he did take off the table the fact that we could be experiencing stagflation. And while seemingly he does not seem to have the confidence to cut rates now, they did say they think that they can get back to 2% to their target without breaking anything. Now, one of the other key things which I mentioned before, Ricardo, has seen a bit of a positive tone in risk assets, particularly our local market today, that he did dismiss the possibility of a rate hike and did again say that he thought rates were restrictive for now, and that the lagged impact of monetary policy would take its time to work through the economy. So it was good that he did, I guess, acknowledge that rate cuts are premature from here, but it did seem like a very dovish statement overall. And just to be specific in terms of your question, the Fed statement did, I guess, bring around some interesting changes. The first one was that they specifically acknowledged there is a problem with inflation decelerating from here. It has been very sticky, and progress to their 2% goal stored. The other thing, which was a surprise, Ricardo, is that they've started to taper their quantitative program or quantitative tightening program, which means it's a little bit strange because you're almost putting a little bit of liquidity back into the market at a time when you could see that delay the ability to cut rates further. So it could prove to be a little bit problematic or a little bit too dovish.
You mentioned earlier that different central banks around the world are in different positions, right? Next week, it's the Reserve Bank of Australia's turn. Can we go into more detail about what you are expecting the board to do and say? Because you mentioned what the markets are thinking, right? Because the other interesting thing that the OECD said overnight is that just because one country may cut rates, and I guess we're referring to really the US, it doesn't necessarily mean everyone will immediately follow.
Yeah, it's a good question, because what happens, Ricardo, if there is a big divergence, and we're seeing that with the yen, the Japanese yen, where the Bank of Japan's got interest rates at 10 basis points, the yen's at basically a 40-year low and probably about 40% undervalued versus purchasing power parity. What happens is if you get a big difference in short end rates, that currencies start to diverge. You have currency wars. So in terms of the RBA, it's definitely going to be an interesting meeting, because we did have a big upside surprise to Aussie inflation just last week. It was 1% core printing for the March quarter and 4% for the year. So there's an argument to say that the RBA really should be hiking. If you think about where we are at 4.35%, if you compare that to some of the other developed market or G7 peers, you've got the RBA of New Zealand, or the RBA NZ, sorry, about 5.5%. The US is at 5.25 to 5.5, and Britain's at 5.25. And it is clear we do have an inflation problem here. I think for the meeting next week, which is on Tuesday, the cash rate will stay at its 12-year high of 4.35%. There's only 7% probability of a hike being priced in. But really the key thing will just be the policy statement and the media conference to see if we do get back to a tightening bias. And if we look at what pricing is to the end of the year, there's a nearly a 50% probability of a rate hike in Australia before year end. So that whole theme of high for longer is certainly front and centre.
And finally, where do you see the opportunities for investors at the moment?
I think being really well diversified, Ricardo, just because the narrative is shifting almost every month, and it has been for about 3 years. So tactical asset allocation is very important. I think we're well and truly out of the environment where a rising tide is lifting all boats. That was a zero interest rate environment. We're now in a higher and more volatile environment for inflation. I think as well, Ricardo, just to set the theme with that question is, if you think about what drives markets, it's earnings and interest rates, and the messaging coming out of the US Federal Reserve is really starting to become unclear again. What I'm concerned about is that the Fed could now be on a path to making yet another dovish mistake. And we saw that all the way back in 2021, where they only retired their reference to being transitory in November. So we could continue to see the market and the market leadership shifting. So we need to be very tactical. We need to be very responsive to the market backdrop. In terms of things that we're avoiding at the moment, global bonds, again, we just think we'll continue to see the yield curve steepen and weakness in long end yields. Global small caps could become very interesting. Have to be careful of higher for longer. There is some benefits with reshoring related to geopolitics in the US that will benefit global small cap industrials. So it's a really interesting space. Credit, if we look at just investment grade corporate bonds, Ricardo, we can get about 7% buying tier 2 debt in Australia. And the other area that we like, that we do focus on at Drummond, is private markets. And one place would be private structured credit, where you can get close to 11% yield with the same credit risk as public RMBS, but in the private space. So that's a few examples.
That's Nick Schoemaker there, a client portfolio manager at Drummond Capital. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.